What makes Warren Buffett the best investor in history? If you invested $1,000 in Berkshire Hathaway when he took over, that will be worth $21 million right now. It is because he managed to get a 20% return on investment every single year, and it shows the amazing power of compounding. What's up guys, my name is Bob, welcome to my channel, and today I want to speak about the 6 investment principles that Warren Buffett lives by and that made him the man he is, and that made him the man who, if you invested $1,000, it would now be worth 21 million. So number 1 is that he believes that the worst thing you can have is too much cash. Yes, he believes, just like what I always say, to have a war fund, to have enough cash to live for about 6 months if you have no cash coming in at all. But anything other than that is what he calls excess cash. And the main issue with that is we have inflation, especially with what's going on in the world right now. So much more money is being printed every single time. So if you simply buy and have cash, it will slowly become worth less and less and less. So the worst thing you could potentially do is actually have too much cash.
Cash is always a bad investment. I mean, when people said cash is king a year ago, I mean, that's crazy. I mean, cash wasn't producing anything, and it was sure to go down in value over time.
That brings us to the second principle, and that is that he believes that you should be investing in assets that actually produce money. And he has a great example where he speaks about you could buy all the gold in the world. You can sit on top of this mountain of gold and look down on the world and feel like the king of the world, as he says it. And then all you're doing is hoping that one day someone else will come who is so afraid of what will happen to the dollar, so he will pay you more for the gold than what you have bought it for. And the only reason that that person will buy it is because he thinks that later someone else will come and will be even more scared of what will happen to the dollar with inflation, so he will pay even more. So rather than buying all that in gold, buy something that will actually start producing money for you, like stocks. In his case, businesses, of course, because he doesn't just buy like 5 or 10 stocks of a business, he buys businesses or real estate or whatever. But he believes that you should really focus and invest in things that will start generating money, and that way you can keep reinvesting this and the whole compounding. And again, $1,000 when he started would mean a 21 million right now, and that's just because he really lived by this rule. Only invest in things that bring you more money so you can reinvest that, which will bring you more money so you can reinvest that, and that is the power of compounding.
Well, the whole idea of investment is to lay out money to get more money back later on, right? And if you buy a farm, or you buy an apartment house, or you buy into a business, either one you own directly or one you own a piece of through stocks, you are buying into an asset that you expect to produce something later on.
As number 3, he believes it is super important that you stay within your circle of competence, as he names this. So that basically means invest in things that you understand. And your circle doesn't have to be really, really big. You don't have to know everything about everything. I mean, let's be honest, that's not even really possible. Find your field, find the type of businesses or whatever you want to be investing in, and start to become obsessed with it and start to know as much as possible about that field, about that circle, and then only invest in those things. I've said this before, don't buy Tesla because people say buy Tesla. Buy Tesla because you understand that it is also a battery company, you understand what they're doing, what the potential is, what problem they're solving, and then look at, is it a good investment? But don't ever buy something because people are just getting hyped about it. When people are just buying things and everyone on the street is talking about Bitcoin or Tesla, you should buy it, that's when I get scared, because that means that people are buying, the price is going to shoot up without the company actually evolving to justify the price. Again, invest in your circle of competence, and it doesn't have to be really big.
I have an old-fashioned belief that I should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now.
The 4th thing that he says, and I realize that is difficult, and I realize that is something especially interesting where you have as much firepower and money buying power as what he has, but he says don't look at the stock price, start by looking in what you think the stock price should be. That is really next level investing. I understand that, because we look at what should the price be by looking into all the assets of a business. Is it in a growth market? What is the potential? how much profit are they currently making and how many shares do they have outstanding. So that is, the ratio between profit and price. And based on that, think this is the price that I think it's worth right now. And if the current price, trading price, is below that price, it means that you can buy at a discount and you should be buying. And if it's much higher, like for example, I'm 100% sure that his vision right now on Tesla, while I'm recording this, it's at $850. If you look at all the assets and all the growth potential, it is probably higher than what he values it at, so he will not be investing. And I think it's a super, super interesting thing when you're doing individual stocks, and it is a skill that is difficult to do, but if you do it, it gives you so much power. And I think it is a super cool thing to keep in mind.
Now, I didn't look at the price first. I look at the business first and try and figure out what it's worth, because if I look at the price first, I'll get influenced by that. So I look at the company first. I try to value it, and then I look at the price, and if the price is way less than what I've just valued it at, I'm going to buy it.
As number 5, he says that you should be investing in yourself. And investing in yourself means buying books. Read as much as you can about investing, about that circle of competence. It will give you such an amazing ROI. It's so easy to make mistakes if you let your emotions guide you and don't do your proper research. So invest in yourself in terms of getting knowledge on investing, getting knowledge on businesses. If you feel like you need a coach, get a coach. If you feel like you need a course, get a course. Listen to podcasts, watch videos on YouTube. But really take that time and invest in yourself so you can take better investment decisions. With better investment decisions, better return comes. So it will pay itself so easily. And I believe always the most important investment to make.
Well, I'll give you 2 pieces of advice. I'd invest as much in myself as you can. I mean, you're your own biggest asset by far. I mean, you've got all kinds of potential, all the people in this room.
And the last thing that he says is look for great opportunities. That's based on basically everything that we've discussed so far. And once you find a good opportunity, go for it. Don't doubt, go for it. Again, in his case, that might mean buying a whole company. But for us, that might mean don't just think, okay, I think it's super interesting, so I'll buy a few shares and see what's going to happen. No, if you have the experience, if you have the knowledge, if you have done all your research and you really see an amazing opportunity, buy heavy. And with buy heavy means it's fine if it's a decent portion of your portfolio because you've done all that research and you see the potential. Keeping your money in cash, that's only going to mean that your money is going to be worth less. You're not going to find 500 opportunities in a year. You'll find every year there's a few moments or a few businesses or a few things that you find which are amazing opportunities. Think back to 2020. From March till now, the S&P 500 doubled, right? So even if you bought an index tracker in March or April, you are at 100% return already, just because you saw this amazing opportunity and you went all in. So those are the things that you should be looking out for. Don't just buy because you're scared that something will happen or that you might miss the boat. Do your research, know when it's a good opportunity, and buy. So these are the 6 things, the 6 principles that Warren Buffett is really using. Again, some are more high level, so maybe not for a starting investor, but it's very good to at least be aware of the way that he thinks and the way that a lot of super experienced investors are thinking. And if this was of value and you watched all the way to the end, you might as well subscribe if you haven't. Hit the like, comment, let me know your thoughts, let me know your investment strategies, and I will see you in the next one.